Financial analysis for beginners. We've looked at the company's financial statements. We've seen the assets they carry, their profits, and their sources of cash. But now what? How do we know if that is good or bad? How do we make sense of the numbers? This is where financial analysis comes in. Financial analysis is a tool to understand the company. It is a core part of fundamental analysis that focus on the numbers that tell the real story of a company. Financial analysis is the process of evaluating a company's financial statements to assess its performance, financial health, and value. These are the most common and simplest financial tools that any beginner can confidently use on their own: vertical analysis, horizontal and trend analysis, ratio analysis, and relative valuation. Let's start with vertical analysis. This is a tool to help investors see how each item in the financial statements compares to something bigger. It can show us how each part contributes to the whole. The formula is simple. You just divide each line item in the statements by a base figure. The base figure for income statement is revenues, while the base figure for the balance sheet is total assets. In this example, the company's biggest asset is investment properties at 95.5% of total assets, followed by cash at 2.9%, then receivables at 1.2%. Now the question is this asset composition good or bad? The assessment whether the asset composition is good or not will depend on the industry. Being a REIT, it is normal for majority of its assets to be in investment properties, and a low receivable to total assets could be good, because it could indicate that the company's income is not accumulating in collectibles. Next, let's look at the income statement. Direct cost eats up 17.2% of revenues, and administrative expenses eat up 8.8%. However, the company's fair value adjustments contributed an additional 133% to profits, making income before tax jump up to 209%, bigger than the revenues. We love big profits, so this must be good. Well, not quite. Remember when we talked about normal business operations in the previous video? That concept still applies. Fair value adjustments are non-operating adjustments. As an investor, you want to see profits jump due to operational revenues rather than adjustments and other income. But having these items on the income statement are not bad either. It is just something to take note of when analyzing, especially if they are material amounts. Let's say, for example, we take out fair value adjustments in our analysis. We would get a more reasonable income before tax ratio at 75%. This percentage simply means that out of all of the company's revenues, they are able to keep 75% of it as profits. And that is good. When you apply vertical analysis across the entire financial statement, you get what's called a common size statement, where every item is shown as a percentage. This makes it easier to compare companies because everything is shown on the same scale, no matter how big or small the business is. We can see who holds the most cash, who has the highest receivables or the most debt. We can see who spends more in direct cost and administrative expenses, and we can see who is the most cost efficient. And if we want a reasonable comparison, we can remove fair value adjustments to see who has the better profit margin. Now let's track movement. Horizontal and trend analysis looks at financial statements from multiple periods to see how things change over time. This looks at the change in peso value and percentage change. Peso value is the difference between the current year amount and the base year amount. Percentage change is calculated by dividing peso change by the base year amount. Horizontal analysis compares the same line items from two periods. You can see if a number has gone up or down and by how much. Now we're back to the question, is this good or bad? As a general rule, we want profits and assets to increase, and we want expenses and liabilities to decrease. But a good habit to follow is to investigate material movements and form your judgments based on it. For this, you can use the notes to financial statements. You could also refer to the company's guidance or the analyst's forecast to check if the company underperformed or overperformed. Trend analysis is a longer view. Instead of comparing just 2 years, it shows the direction over several periods. Through trend analysis, we can see the growth in core revenues and total assets, a dip in net income, and a spike in total borrowings. This helps spot patterns such as steady growth, decline, or sudden spikes. Now let's review. Vertical analysis tells us what matters within a single period by showing us insights into the composition of the financial statements. Horizontal or trend analysis shows how things change over time, revealing growth, decline, or red flags. Together, they help us see the bigger picture, so you're not just reading financial statements, you're understanding them. And once we've got a handle on the structure and movement of the numbers, the next step is measuring performance. That's where ratio analysis comes in. We'll break that down in the next video. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.